Hello, today I'd like to talk about a few tax issues which at the seminar I presented at Carlston Hotel in Marina Del Rey a few days ago, and few professional engineers and other professionals, they asked me questions between the difference between the Schedule C, LLC pass-through and S corporation pass-through. I like to first, my name is Shahrat Tadayon, licensed by the Treasury Department, area of taxation, practicing in the area of taxes over 34 years. And I have a doctorate degree in the area of finance and lectured many universities in Southern California. So this difference of Schedule C. Schedule C is something that it's a form. Schedule C is inside of your individual tax return 1040. So any income that you have from any business activity, you will have a Schedule C. And then your net of income, you will pay Social Security tax, SE, which is 15.3%, income tax, and state and federal. But we have to be very careful with Schedule C because this is the area of that a lot of time being questioned if the income and expense are not proportional, and also is not meeting the criteria of the industry, especially if you are using the home business or using the business for personal and automobile for business, and also for personal. So we have to be very careful on that matter. Now, what is the LLC? We have two kinds of LLC, which limited liability company. One is the holder of the real estate or having real estate properties, and you are getting on your K1, they call pass-through, you're having pass-through from rental income or losses. But we have to be very careful that we have basis for this losses that we are carrying or going to your personal through pass-through. And so you on your pass-through and passive income, only federal and state income taxes paid, not Social Security. But if this a limited liability company is a business entity, which is like professionals or mercantile and so forth, which is create ordinary income, at that time you are going to have pass-through, and there is a section inside of the K1, they call it self-employed. So all of them pass through to your individual, and so you are going to pay on individual, federal, state, and Social Security taxes of about 15.3%. Now, what is the maximum for this 2022 is like $147,000, and for 2023 it will be $160,000. The threshold after that figure, you don't pay 12.4%, only unlimited on the Medicare of 2.4%. So what is the difference now with the S corporation? S corporation is different entity. Is like you are doing business either as ordinary income most of time, and then you can have passive income on that one too, but it has to be separated. So if you have in most of time people, they have a S corporation is under 100 people, and you elect make it a S corporation, subchapter S corporation, which the most important in S corporation, which unfortunately many people ignore it, is not paying a reasonable amount of compensation for the salary for the officer and shareholder, and all the income or most of that pass through to individual through K1, and they pay income taxes, federal and state, no Social Security. So this is the area which are question, especially on Tax Cut Job Act of December 17, 2017. They say reasonable is 75% of your net income, but if you can pay even 50%, it is still reasonable. And after, remember, the limited threshold is $147,000. And after that, you, rather than 12.4%, you are not going to be paying only 2.45%, which is for Medicare. So we have to be very careful on pass-through to have reasonable compensation for the officer, which is very, very important area. And now they are watching this area because government is after the Social Security, which with passing through, they are not paying that, a total of 15.3%. So let me say that if you're passing this through the LLC passive income from rental income to your personal, you have limitation on the usage of these losses if you have. If your income, spouse and you or husband and wife is above $150,000, you are limited to, basically, you are not going to be able to take anything. It is unallowed, and you will keep it for the future. And in the future, if you have a rental passive income, it will be offsetting with each other. But if the income is under threshold of $150,000, then in that case, you are up to $25,000. You can have passive income if you are participating, active participant, paying rent, collecting rent, and so forth. And if you are a material participant, it means your job is really buying property, selling property, and that's all you do exclusively, and you're spending over 500 hours on so many other criteria, then they call it material participant, so you are unlimited on the passive income losses. But we have to be distinguished between the material participant and active participant. And there are many other tax issues, but because this brought up but few professional engineers at the seminar, I wanted to clarify for them. Hopefully we have some other issues which I will discuss. Shara Tadayon, thanks for watching.